Value Investing 101. Financial Guru here. It is time to learn what is value investing. How does it work? What is intrinsic value? What tools, news articles, cycles, and financial terms do we need to know? What do the different types of value investing mean? And so much more. Let's invest now so we can value our worth with abundance into the future. First, what is value investing? Value investing is an investment strategy that involves picking stocks that appear to be trading for less than intrinsic or book value. Value investors actively ferret out stocks they think the stock market is underestimating. They believe the market is overreacting to good and bad news, resulting in stock price movement that do not correspond to the company's long-term fundamentals. The overreaction offers an opportunity to profit by buying stocks at a discounted price. How does value investing work? The basic concept behind everyday value investing is straightforward. If you know the true value of something, you can save a lot of money when you buy it on sale. Most people would agree that whether you buy a new TV on sale or at full price, you're getting the same TV with the same screen size and picture quality. Stocks work in a similar manner, meaning the company stock price can change even when the company's value or valuation has remained the same. Stocks, like TVs, go through periods of higher and lower demand, leading to price fluctuations. Just like a savvy shopper would argue that it makes no sense to pay full price for a TV, since TVs go on sale several times a year. The same as savvy value investors believe stocks work the same way. Of course, unlike TVs, stocks won't go on sale as predictable times of the year, such as Black Friday, and their sale price won't be advertised. Value investing is the process of doing detective work to find these secret sales on stocks and buying them at a discount compared to how the market values them. In return for buying and holding these value stocks for the long term, investors can be rewarded handsomely. Intrinsic value and value investing. In the stock market, the equivalent of a stock being cheap or discounted is when its shares are undervalued. Value investors hope to profit from the shares they perceive to be deeply discounted. Investors use various metrics to attempt to find valuations of intrinsic value on a stock. Intrinsic value is a combination of using financial analysis, such as studying a company's financial performance, revenues, earnings, cash flows, and profit, as well as fundamental factors including the company's brand, business model, target markets, and competitive advantage. Some metrics used to value a company's stock includes price to book or book value, which measures the value of a company's assets and compares them to the stock price. If the price is lower than the value of assets, the stock is undervalued, assuming the company is not in financial hardship. Price to earnings ratio, PE ratio, which shows the company's track record for earnings to determine if the stock price is not reflecting all the earnings or undervalued. Free cash flow, which is the cash generated from a company's revenue or operations after the cost of expenditures have been subtracted. Free cash flow is the cash remaining after expenses have been paid, including operational expenses and large purchases called capital expenditures, which is the purchase of assets like equipment or upgrading a manufacturing plant. If a company is generating free cash flow, it'll have money left over to invest in the future of the business, to pay off debt, pay dividends, or rewards to shareholders, and issue share buybacks. Now the next one is the most important one to me as a value investor, and one that I think you should really look into, and that's the margin of safety. Value investors require some room for error in their estimation of value, and they often set their own margin of safety based on the particular risk tolerance. The margin of safety principle, one of the keys to successful value investing, is based on the premises that buying stocks at bargain prices give you a better chance at earning a profit later when you sell them. The margin of safety also makes you less likely to lose money if a stock doesn't perform as you had expected. Value investors use the same sort of reasoning. If a stock is worth $100 and you buy it at $66, you have made a profit of $34 simply by waiting for the stock price to rise to the $100 true value mark. On top of that, the company might grow and become more valuable, giving you a chance to make even more money. If the stock price rises to $110, you would have made $44 since you brought the stock on sale. If you had purchased it at its full price of $100, you would have only made 10%. Benjamin Graham, the father of value investing, only bought stocks when they were priced at 2/3 or less than their intrinsic value. This was the margin of safety he felt was necessary to earn the best returns while minimizing investment downside. Markets are not efficient. Value investors don't believe in the efficient market hypothesis, which says that stock prices already take all information about a company into account, so their price always reflects their value. Instead, value investors believe that stocks may be over or underpriced for a variety of reasons. For example, a stock might be underpriced because the economy is performing poorly and investors are panicking and selling, as was the case during the Great Recession. Or a stock might be overpriced because investors have gotten too excited about an unproven new technology, as was the case in the dot-com bubble. On a psychological bias can push a stock price up or down based on news, such as disappointing or unexpected earning announcements, product recalls, or litigation. Stocks may also be undervalued because they trade under the radar, meaning they are inadequately covered by analysts and the media. Whatever you do, don't follow the herd. Value investors possess many characteristics. They don't follow the herd. When everyone else is selling, they are buying or holding. Value investors don't buy trend stocks because they typically are overpriced. Instead, they invest in companies that aren't household names if the financials check out. They also take a second look at stocks that are household names when those stock prices have plummeted, believing such companies can recover from setbacks if their fundamentals remain strong and their products and services still have quality. Value investors only care about a stock's intrinsic value. They think about buying a stock for what it actually is, a percentage of ownership in the company. They want to own companies that they know have sound principles and sound financials regardless of what everyone else is saying or doing. Value investing requires diligence and patience. Estimating the true intrinsic value of stocks involves some financial analysis but also involves a fair amount of subjectivity, meaning at times there can be more of an art than a science. Two different investors can analyze the exact same valuation data on a company and arrive at a different decision. Some investors who look only at existing financials don't put much faith in estimating future growth, where other value investors focus primarily on a company's future growth potential and estimate cash flows. And some do both. Despite different approaches, the underlying logic of value investing is to purchase assets for less than they are currently worth and hold them for the long term, and profits when they return to the intrinsic value or above. It doesn't provide instant gratification. You can't expect to buy a stock for $50 on Tuesday and sell it for $100 on Thursday. GameStop. There is no glitch in the system. Sometimes it works, but value investing hardly ever happens. Instead, you may have to wait years before your stock investment pays off, and you will occasionally lose money. The good news is that for most investors, long-term capital gains are taxed at a lower rate than short-term investment gains. Like all investment strategies, you must have the patience and diligence to stick with your investment philosophies. Some stocks you might want to buy because the fundamentals are sound, but you have to wait if it is overpriced. You want to buy the stock that is most attractively priced at that moment. And if no stock meets your criteria, you have to sit and wait and let your cash sit idle until the opportunity arises. This, folks, is the hardest thing to do in value investing. I tell you what, this is definitely a skill you need to practice and learn. You're saving money and next minute you see the stock like Tesla, for instance, has skyrocketed and you think you've got to get in. And what happens? You buy in and next minute you've lost $300 later on. Same with a company like Zoom Technologies has dropped a few $100s from its peak. This is the danger if you don't value invest. And keep your money in cash till you need to absolutely put in a big position in the company. It's hard to do, but trust me, you will make more money in the long term by doing this. Why stocks become undervalued? If you don't believe in the efficient market hypothesis, you can identify a reason why stocks might be trading below their intrinsic value. Here are a few factors that can drag a stock price down and make it undervalued. Market moves and herd mentality. Sometimes people invest irrationally based on physiological biases rather than market fundamentals. When a specific stock price is rising, or when the overall market is rising, they buy. And they develop a fear of missing out. Conversely, when a stock price is falling, or when the overall market is declining, loss aversion compels people to sell their stock. So instead of keeping their losses on paper and waiting for the market to change directions, they accept a certain loss by selling. Such investor behavior is so widespread that it affects the price of individual stocks, exaggerating both upward and downward market movements. Now another one to look at is market crashes. When the market reaches an unbelievable high, it usually results in a bubble, but because the levels are unsustainable, investors end up panicking, leading to massive sell-offs. This results in a market crash. That is what happened in the early 2000s with the dot-com bubble, when the value of tech stocks shot up beyond what the companies were worth. We saw the same thing happen when the housing bubble burst and the market crashed in the mid-2000s. And also recently, due to the Rona in March 2020, where just about every stock, 50%, you could have got a bargain. Unnoticed and unglamorous stocks. Look beyond what you are hearing in the news. You may find really great investment opportunities in undervalued stocks that may not be on people's radars, like small caps or even foreign stocks. Most investors want in on the next big thing, such as technology startups, instead of a boring, established consumer durable manufacturer. For example, stocks like Facebook, Apple and Google are more likely to be affected by the herd mentality, instead of investing in the likes of Procter & Gamble or Johnson & Johnson. In saying that, I really love Apple. Bad news, even good companies face setbacks such as litigation and recalls. However, just because a company experiences one negative event doesn't mean that the company isn't still fundamentally valuable or that its stock won't bounce back. In other cases, there may be a segment or division that puts a dent in the company's profitability. Like for instance, Disney at the moment with Disney Plus, all their profit has been slashed, but within about 5 years' time they believe to be profitable, which will lead to further and further gains in 10 years' time. But going back to companies' profitability, but that can change if the company decides to dispose or close that arm of the business. Analysts do not have a great track record for predicting the future, and yet investors often panic and sell when a company announces earnings that are lower than analyst expectations. But value investors who can see beyond the downgrades and the negative news can buy stocks at deeper discounts because they are able to recognize a company's long-term value. If we look at the cycles are defined as a fluctuation that affects a business. Companies are not immune to ups and downs in the economic cycle, whether that's seasonality, time of year, or consumer attitudes. All this can affect profit levels and the price of the company's stock, but it doesn't affect the company's value in the long term. The key to buying an undervalued stock is to thoroughly research the company and make common sense decisions. Value investor Christopher H. Brown recommends asking if a company is likely to increase its revenue via the following methods: raising price of products, increased sale figures, decreasing expenses, selling off or closing down unprofitable divisions. Brown also suggests studying competitors to evaluate its future growth prospects, but the answer to all of these questions tend to be speculative, without any real supportive numerical data. Warren Buffett, one of the value investor gurus, recommends investing only in industries you have personally worked in, or whose consumer goods you are familiar with, like cars, clothes, appliances, food, and so many other industries that you might be in. One thing investors can do is to choose a stock or company that sell high demand products and services. While it is difficult to predict when innovative new products will capture market share, it's easy to gauge how long a company has been in business and study how it has adapted to challenges over time. Insider buying and selling. For our purposes, insiders are the company's senior managers and directors, plus any shareholders who own at least 10% of the company's stock. A company's manager and directors have unique knowledge about the company they run, so if they are purchasing its stock, it's reasonable to assume that the company's prospects look favourable. Likewise, investors who own at least 10% of the company's stock wouldn't have bought so much if they didn't see profit potential. Conversely, a sale of a stock by an insider doesn't necessarily point to bad news about the company's anticipated performance. The insider might simply need cash for any number of personal reasons. Nonetheless, if a mass sell-offs are occurring by insiders, such a situation may warrant further in-depth analysis of the reasons behind the sale. What about analysing earning reports? This is another very important one for you people out there to always look at this stuff, because a company might at one stage look good, but in a year's time it may change and improve or go down in terms of where it is heading into the future, depending on what the type of investor you want to be. And if you're into value investing, you need to be checking this out all the time, every 6 months at least. At some point, value investors have to look at the company's financials to see how it's performing and compare it to industry peers. Financial reports present a company's annual and quarterly performance results. The annual report is a SEC form called 10K, and the quarterly report is a SEC form called 10Q. Companies are required to file these reports with the Securities and Exchange Commission. You can find them at the SEC website of the company's investor relations page on their website. You can learn a lot from a company's annual reports. It will explain the products and services offered, as well as where the company is heading, which also leads to analysing their financial statements. A company's balance sheet provides a big picture of the company's financial condition. The balance sheet consists of two sections, one listing the company's assets and another listing the liabilities and equities. The assets section is broken down into a company's cash and cash equivalents, investments, accounts receivable or monies owned from customer inventories, and fixed assets such as plant and equipment. The liabilities section lists the company's accounts payable or money owed, accrued liabilities, short-term debt and long-term debt. The Shareholders Equity section reflects how much money is invested into the company and how many shares outstanding and how much the company has retained earnings. Retained earnings is a type of savings account that holds the cumulative profits from the company. Retained earnings are used to pay dividends, for example, and is considered a sign of a healthy, profitable company. The income statement tells you how much revenue is being generated, the company's expenses and profits. Looking at the annual income statement rather than a quarterly statement will give you a better idea of the company's overall position. Since many companies experience fluctuations in sales volumes during the year, studies have consistently found that value stocks outperform growth stocks and the market as a whole over the long term. Well, there'll be some of you out there saying, am I a couch potato value investor? It is possible to become a value investor without ever reading a 10K. Couch potato investing is a passive strategy of buying and holding a few investment vehicles for which someone else has already done the investment analysis, i.e. a mutual fund or exchange trade fund. In the case of value investing, those funds would be those that follow the value strategy and buy value stocks, or track the moves of a high-profile value investor like Warren Buffett. Investors can buy shares of his holding company, Berkshire Hathaway, which owns or has an interest in dozens of companies that the Oracle of Omaha has researched and evaluated. Risk with value investing. As with any investment strategy, there is the risk of loss. With value investing, despite it being a low to medium risk strategy, below we highlight a few of those risks and why losses can occur. The figures are important. Many investors use financial statements when they make value investing decisions. So if you rely on your own analysis, make sure you have the most updated information and that your calculations are accurate. If not, you may end up making a poor investment or miss out on a great one. If you aren't yet confident in your ability to read and analyze financial statements and reports, keep studying these subjects and don't place any trades until you truly are ready. One strategy is to read the footnotes. These are the notes in the form of 10K or Form 10Q that explain the company's financial statement in greater detail. The notes follow the statements and explain the company's accounting methods and elaborates on reported results. If the footnotes are unintelligible or the information they present seem unreasonable, you have a better idea of whether to pass on the stock. How about extraordinary gain or losses? There are some incidents that may show up on the company's income statement that should be considered exceptions or extraordinary. These are generally beyond the company's control and are called extraordinary items, gains or losses. Some examples include lawsuits, restructuring, or even a natural disaster. If you exclude these from your analysis, you can probably get a sense of the company's future performance. Critically about these items and use your judgment. If a company has a pattern of reporting the same extraordinary items year after year, they might not be too extraordinary. Also, if they are unexpected losses year after year, this can be a sign that the company is having financial problems. Buying overvalued stock. Overpaying for a stock is one of the main risks for value investing. You can risk losing part or all of your money if you overpay. The same goes if you buy a stock close to its fair market value. Buying a stock that's undervalued means your risk of losing money is reduced even when the company doesn't do well. Recall. That's one of the fundamental principles of value investing, is to build a margin of safety into all your investments. This means purchasing stocks at a price of around 2/3 or less of intrinsic value. In my point of view, more closer to 50% or even lower if you can get it. Value investors want to risk as little capital as possible in potentially overvalued assets, so they try not to overpay for investment. Conventional investment wisdom says that investing in individual stocks can be a high risk strategy. Instead, we are taught to invest in multiple stocks or stock indexes so that we have exposure to a wide variety of companies and economic sectors. However, some value investors like myself, believe that you can have a diverse portfolio even if you only own a small number of stocks, as long as you choose stocks that represent different industries and different sectors of the economy. Which I would go further and say you can just be in one or two sectors. If you find companies on special, buy them. Value investor and investment manager Christopher H. Brown recommends owning a minimum of 10 stocks in his little book of value investing. According to Benjamin Graham, a famous value investor, look at choosing 10 to 30 stocks if you want to diversify your holdings. But to me, for someone in a smaller, like 100k or less range, I would look at 5 stocks only. As another set of experts say differently, if you want to get big returns, try choosing just a few stocks. According to the authors of the second edition of Value Investing for Dummies, they say having more stocks in your portfolio will probably lead to an average return. Of course, this advice assumes that you are great at choosing winners, which may not be the case, particularly if you are just starting out, but you will learn over time. Listening to your emotions. It is difficult to ignore your emotions when making investment decisions. Even if you can take a detached, critical standpoint when evaluating numbers, fear and excitement may creep in when it comes time to actually use that part of your hard-earned savings to purchase a stock. More importantly, once you have purchased a stock, you may be tempted to sell it if the price falls. Keep in mind that this is the point of value investing, is to resist the temptation to panic and go with the herd. Don't fall into the trap of buying when share prices rise and selling when they drop. Such behavior will obliterate your return. Playing follow the leader in investing can quickly become a dangerous game. But sometimes you have to pull out of the race on your value investing if the company just continues to go down. Sometimes that is because the company is just going bust, but you have to keep re-evaluating because sometimes it can still be a gold mine for you as a value investor. So what is the bottom line? Value investing is for the long term. Value investing is a long-term strategy. Warren Buffett, for example, buys stocks with the intention of holding them almost indefinitely. He once said, "I never attempt to make money on the stock market. I buy on the assumption they could close the market the next day and not reopen it for 5 years and you will be fine." You will probably want to sell your stock when it comes time to make a major purchase or retire. But by holding a variety of stock and maintain a long-term outlook, you can sell your stock only when the price exceeds their fair market value and the price you paid for them. I'm not fully a value investor. I also use growth investing in my strategies to buy stocks. I also plan to have a dividend investing strategy put in place. There are a few stocks that cover all three, but getting them at the right price is key. If value investing resonates with you, that's great to hear, but I will discuss other investing strategies on this YouTube channel. It is time for me to jump on the ship just before it hits rock bottom, as the tides will turn towards redemption, and you will sail away with money for life. Until we meet again, you have a lovely day out there.